Welcome to the Rosenberg Roundup. I'm Dylan Smith, and I'm flying solo today. Jacob is unfortunately out, but when the cat's away, the mice will play, and this gives me license to indulge in what I hope will be a spicy episode. So after the usual week in review and a look to the week ahead, we'll be taking on the economists of the Kansas City Fed, who seem to think that consumer indebtedness is nothing at all to worry about. We'll also pop by Canada Corner for a change to check on developments up north. Spoiler alert, more of the same. So with that, let's get into it. All the biggest news this week driving markets came from earnings reports as we enter the final weeks of earnings season. Nvidia has been the hottest stock in the world for some time, and it retained the title after shooting the lights out with an outperformance of its Q1 targets, guidance upgrades, and a 10-for-1 stock split. That saw Nvidia's share price move above $1,000 per share, and it's now larger than Tesla and Amazon combined and just 17% behind Apple for the title of most valuable company in the world. Those strong results from Nvidia reverberated through the tech sector, which outperformed the rest of the market this week, and the AI semiconductor theme clearly has real legs. And the relative strength of this sector is not going to go anywhere for a while. But one interesting development here is that the build-out of the computer infrastructure needed to support AI model development is flowing through to, of all things, the utility sector, which is usually one of the most tame and placid and defensive parts of the market. But data centers continue to fly up everywhere, and they need power. So utilities are becoming a sector for all seasons. Still highly geared to interest rates and primed to benefit when the Fed starts cutting. So still fundamentally defensive, but also now picking up some more value-driven or growth-driven tailwinds from the secular rise in the tech sector. But on the other hand, the macro news from earnings continues to be a little deflating. The retailers are sending signals that the consumer is slowing down, especially the consumer sitting in the middle and lower tiers of the income distribution. Just this week, comparable sales at Target stores were down nearly 4%, ditto for Lowe's, while Macy's slumped 1.2%, and management at the firms said that trends in consumer discretionary categories are soft, they're under pressure, the consumer is not immune to macro forces. So all three of these firms join a long list of American companies telling us that the consumer is trading down. And against that backdrop, turning to the Fed minutes, the discussion among the FOMC members on raising rates potentially looks a little jarring. Now, that's not the base case, but it was surprising that that discussion was had explicitly, and it's no surprise that Powell chose to avoid telling us that in his press conference immediately after this meeting, given that that's a very market-sensitive type of discussion to be having and probably hawkish on the margin that it's even being considered. There was a clear split between the hawks and the doves in this Fed minutes, which will only be resolved one way or the other in the next few months by the inflation data. So in terms of the Fed and interest rates, inflation continues to be basically the whole ball game. Finally, the only other notable data point this week was the latest release of the leading economic indicator, which to no surprise fell again, minus 6% month on month, ho-hum. It's telling us that a recession is around the corner. It's been doing that for a long time now, and it's becoming a little bit the indicator that cried wolf. But we still think it's worth taking seriously. There are a lot of countervailing forces that have pushed against the fundamental message that the leading indicator is trying to send us, and it's showing the underlying fragility that's been counterbalanced by those temporary growth forces. So we still keep a close eye on that indicator, and it is still sending a signal of bad news. Looking forward to next week, we're getting our favorite data release, which is the Fed's Beige Book. Of course, that document reports what companies are telling regional Fed officials about the state of their businesses and the economy. As usual, we'll feed that through our LLM model to extract the overall signal that the latest Beige Book is giving to us, and we'll also peruse it for helpful tidbits about what the people who make up the real economy are reporting. We'll also get the latest durable goods report, an important signal on how investment is developing and what that might mean for GDP growth in the second quarter of the year. And we'll get the Conference Board's latest consumer confidence report, where we're looking for a confirmation or rebuttal of the big drop in consumer confidence reported in the University of Michigan survey a couple of weeks ago. Okay, I promised some spice in today's episode, and I'm delivering on that promise here in the Spotlight section, because the Kansas City Fed this week put out a blog pointing out that the debt-to-income ratio for households is at historical lows. So that's total debt held by households, whether it be for autos, for housing, consumer loans, divided by the annual income of the average household. That ratio, according to the Kansas City Fed, is at a historical low. And according to those researchers, that means that consumers have a lot of room to run before experiencing any financial distress, in turn implying that credit-driven growth can continue for a while. Now, clearly these researchers haven't been watching the latest earnings report we've just discussed, but they've made some more fundamental mistakes, although they're not the first to do it. This type of reporting has been, to put it lightly, getting on my nerves for a while, but since this is the latest and most high-profile version of this claim, the Kansas City Fed is going to take the heat for it. Now, the analysis makes three important and very fundamental errors. Firstly, it's not the total debt-to-income ratio that matters, it's the cost of carrying the debt and how much those outbound cash flows of servicing debt relate to income trends. Now, $5 trillion of the total debt was taken out at a time when interest rates were absolutely microscopic, whether after the global financial crisis and the long low-rate period that followed, or during COVID-19 when rates were refloored at the zero lower bound. Now, as that debt gets refinanced increasingly, it's going to have to roll over, and is rolling over, at least a 3 percentage point higher interest rates, which is draining about $150 billion from discretionary income. Now, that's hardly indicative of more room to run for consumer credit-fueled growth. The second error, as any economist who's passed through a postgraduate program in the past 15 years will tell you, is that income distribution matters a lot. Most of this debt, and at least the stressful part of it, resides in the lower end of the income distribution, where it's a huge burden on consumers. It's not all sitting at the top of the income distribution, where income growth has been concentrated, and costs can be offset by return on assets. So that's another way in which this ratio lies to you a little bit. You've got to look at who has the debt. And the third error, maybe the most egregious, is what was meant by historical in this blog post. It only goes back to 2007, where admittedly, debt-to-income ratios were a lot higher. But if you look back further into economic history, we'll see that we're at levels that are higher than any other recession in the past, right? So we're not out of the woods at all. We don't see a lot of room to run. And there's a reason that, to draw a parallel, some countries can carry 100% debt to GDP ratio comfortably, while others struggle to pay their debt servicing at 50%. It's about your interest costs. It's about the ability to service your debts. And the same logic goes for households. And if you want to see whether consumers are stressed or not, take a look at what's happening to default rates, which are at a post-crisis high. So if you want to talk historical highs, there's another one for you, which goes in exactly the opposite direction. So just a word to the wise to be very careful about this type of simple analysis of debt levels. You've got to think about interest costs, and you've got to think about who's holding the debt. Okay, and with that behind us, it's time to be nice again, because we're heading over to Canada Corner. And we're here because Jacob is away partly, so we can escape over to Canada Corner. But we're also here because there's important inflation data that came out this week. And once again, it was incredibly constructive this time for April. This was the fourth really good inflation report in a row now. So basically all year, we've had great inflation news coming out of Canada. The highlights this time, all core measures were well inside the 3% upper limit of the target band that the Bank of Canada sets for inflation. The median and common measures of core inflation were at 2.6%, and CPIX, which includes the 8 most volatile components, is now under 2% in year-on-year terms. Headline inflation year-on-year is running at 2.7%, but if you strip out mortgage interest costs, which only really Canada includes in the index, that index has been basically flat since December. We're seeing virtually no inflation outside of shelter costs in the Canadian economy. And this continues the points we've been banging on about for some time in Canada. The Bank of Canada can certainly and should definitely ease rates this summer. So if that does happen, bonds are in for a good time north of the border. Not so much the Canadian dollar, which will stay weak since Bank of Canada cuts work against it. and the Bank of Canada looks set to go earlier and deeper than the Fed in the short to medium run. That brings to an end another episode of the Rosenberg Roundup. Make sure to leave a review, and I'll be back this time next week with Jacob in tow. I'm Dylan Smith, and that was the Rosenberg Roundup.
Thank you for listening to this week's episode of Rosenberg Roundup. For more information on our work and to take advantage of a free 30-day trial of our research, please visit rosenbergresearch.com. Make sure to tune in to our next episode for more insightful analysis on the macro and market landscape. Rosenberg Roundup is provided for general information and entertainment purposes only and does not constitute legal or professional advice, nor is it an offer to sell or a solicitation of an offer to purchase any security or derivative. Any views expressed by the participants of Rosenberg Roundup are solely their own and do not necessarily reflect the views, opinions, beliefs, or policies of Rosenberg Research.